Let's talk some more volatility. Zed Francis, CIO at Convexitas here in Chicago, the man to go to on that subject. So we're watching VIX kind of because in these big moments, it does stand out. We've talked about over the years how you watch fixed strike vol kind of as a more precise analysis. So take me over the last week here. Since this time last week, when we started off VIX so high, how have you been watching the world, Zed?
Well, mainly, Oliver, I was on vacation last week.
Yeah.
You started at the end of the week in the exact same spot. You're telling me something happened while I was gone?
Uh-huh.
Yeah, no, I think it's really important to, when you're talking about volatility, what are you specifically talking about? How you utilize the tool within your portfolio, and then ultimately, what is your monetization process? Because buy and hold is not often a successful approach.
Yeah, buy and hold vol, right?
Volatility style products. So, I heard you when I was waiting over there talking about VIX. Like, first off, VIX at 65, that's a little bit of, we'll call it a misnomer, right? Because that's the spot VIX contract, which is not tradable. So it's a headline number on a calculation of the underlying S&P option prices that's not an actually tradable number. The front month August VIX future, which is tradable, hit a high of, I think it was like 37.1 that day.
Still not too shabby.
It moved. It went from low 20s to, high 30s, closing about 30 on Monday. But it's not one of those extremely explosive numbers from 20 to 65 type of situation.
The 65 is still math, right? Like, we have the model for it.
But if you can't trade it using any sort of fixed sale product.
You can trade theory, you don't know, right? But then every moment, possibly the market changed. Maybe by the time it opened, it just wasn't worth 65 VIX anymore.
Well, yeah. Well, trust me, the front month future was not anywhere close to that because that's transactable before open as well.
Well, the reason I ask is because basically, even though there's kind of like a nomenclature type discussion, right? But it's also an important point though, because if we look at that VIX, it kind of characterizes the way I've been describing the market because other than COVID, that would be the second highest VIX since GFC, which speaks a lot more loudly to like major regime shift, kind of like nuclear moment versus, a trade went wrong.
Yeah, but I think what we were signaling on Monday is that a trade went wrong, and that's why it subsided so quickly. But my second piece of the monetization side is like, if you were long fixed futures, fixed call options, something in that universe to create some sort of hedge in your portfolio, it was a really difficult hedge to monetize, right? It's like we move aggressively. We basically only held that aggressive move for the first 15-ish minutes Monday. By the end of the week, VIX futures were lower on the week. So it was something that you really had to be quite aggressive monetizing, which frankly I think would have been difficult on that morning, right? It's like sky's falling. Things are moving in your direction for that hedge. When do you take it off? If you didn't just say like, this is the time.
The answer was basically from the moment the bell rang, you had to be first out of the blocks, basically.
That's right. So I'm saying that's a difficult product to use because of the monetization process.
All right. So I see where this is going. Convexitas, tell me what we're supposed to be doing then. What was the learning lesson here?
Well, using fixed strike options. So S&P 500s, in this case, if it was hedging portfolio, S&P 500 puts. Yes, you have similar functionality that you have to actually monetize things along the way. But right off the gate, you don't have to do it in the first 10 minutes on that Monday, right? The market was down 3% by the end of that Monday period. You had an ample amount of time to go ahead and reposition that portfolio because using a fixed strike put, yes, volatility expansion is providing some of that P&L, but a lot of that P&L is simply because the market went down.
The actual S&Ps
That's
are down.
right. So it allowed you some time to go ahead and reposition your portfolio rather than instantaneously have to make that kind of hero ball decision right on the open. This is not going to be Oct 87. This is it. Like, let's take it off now. Having something in the fixed strike space, because it's not all volatility, it's a lot of it's driven, pricing of those options driven by actual market movement, allows you a little bit more time to go ahead and make those decisions. The second piece of it is how we think about the monetization process is it's all risk driven. As your risk changes, you got to get back to home base. That makes a natural rebalancing opportunity, i.e. monetization. And so it's not all this, is it on or off switch? Is it now? It's a market goes down 3%, we probably got to do something. If it went down another 3%, you have to do something else. So having risk-driven monetization processes is incredibly important, especially when you get to these choppy markets.
Understood. Okay, now how about the dispersion and kind of the skew that came with that. I've at least in my mind kind of thought about these as related subjects that maybe also kind of exacerbated this blowout because we were already getting a weird market dynamic where the index was very passive for the most part, but underneath there was like tumult and chaos. So when correlation spiked on Monday, did that kind of normalize too, or where is that right now?
Well, that was the main reason we actually moved in the S&P 500 and moved throughout the week, not only on Monday, is that correlation went from very, very low to more, we'll call it normal-ish. It still is lower than historical norms. Like, correlation has still remained shockingly low through this whole environment, but it went from the basement to a little bit of like the first floor. That's what allowed the market to almost every single day last week actually experience significant movements, because now when the underlying securities that make up the S&P are moving, they were moving all in the same direction for the most part, allowing the index to actually move, which, as you say, was the biggest shift between the first 6.5 months of the year and the last month-ish.
Okay. Now, are your thoughts on the Japanese thing, that it was more kind of fuel already onto a fire? It kind of sounds like maybe then you would argue that trade, that the skewness of the market and the kind of tech-driven dispersion was as much basically as tender.
Yeah, I mean, I think these types of events always waterfall. So the first thing people were getting dinged on was basically, what we describe as the rotation.
Yep.
In reality, it was what everybody was long was going down, and what everybody was short was going up.
That was the tech down, small caps up,
or value-ish, or along those lines up, right? So that was kind of pain point number one. Pain point number two was definitely the yen carry trade unwind. The unwind for that, for the we'll call it prop desks and CTA type funds, is rapid. They hit those risk limits, you got to get out of that. That trade is definitely embedded in other things that people use it as like term funding type situations. Now, that's not necessarily forced to be unwind like things in we'll call it the prop and or CTA world. So those positions are probably still on, but that's mostly, we'll call it unrealized losses in those types of situations rather than forced unwinds. So there's probably more losses to be seen from that unwind in the future.
Steve, the yen keeps breaking out. There's more pain associated with that?
Yeah, but it's folks that are kind of buy and hold for 10-year type positionings, truly using it as a funding vehicle to hold assets in the portfolio. So it might create some we'll call it earnings problems in the future, but it's not an unwind event.
The people that were playing it with a little bit more fire are the ones that already got burned, basically.
Yeah.
If you were using it as kind of shorter term, high frequency leverage, liquidity, then you got tapped on.
Yeah, but like think of it like a traditional CTA kind of momentum type of situation.
Yeah.
Those folks, as soon as that flips, they're out.
One more for you real quick. The 0-day stuff. It seemed like the volume in that actually kind of, as I understand, was a little bit light last week in the middle of some of the storm, or I think that's what we heard from SIBO's Henry Schwartz.
Yeah, no, it was definitely lighter. I think the 0DTE stuff is mostly a boogeyman, and the main reason for that is there's kind of like no second domino. It doesn't cause other trading. If you sell a put, you sell a call, that a cash settles at the end of the day. The end of the day happens. There's no risk. You go home with no risk. So I don't see that being like the trigger for the next event. Now, some of those programs might have things that say, we sell it on Monday, and if XYZ happens, we just don't sell it on Tuesday. I wouldn't be surprised if those programs have something that just say, like, do not participate during certain events, which is probably a little bit of the driver of why I went from like 40-odd% of volumes to mid-20-ish% of volumes last week. But I don't see it as that ultimate boogeyman, simply because there's no carry-on effect. You don't go home with any risk, so there's no forced trading afterwards.
Right. Good point. Yeah, it's all in that day.
And you're out.
You're out. Okay, a great dissection of the past week. Some good thoughts on lessons learned in hedging. Appreciate it, Zed. Good
Thanks,
stuff.
Oliver.
Mr. Francis, CIO at Convexitas.